Private equity giant Blackstone reporting third-quarter results earlier this morning. Revenue and profit both missed the street's expectations, though Blackstone's CEO said in the earnings release that the company is, in his words, well-positioned with a record amount of dry powder, some $200 billion. Blackstone's total assets under management grew 6% in the quarter. And for more on this, we want to bring in Jon Gray. He's the president and chief operating officer of the Blackstone Group. And John, just looking at a few things, the distributable earnings were down by a steeper than expected 12% year over year. Steve Schwarzman said that this is what's happening. These results are coming in, and he described a pretty challenging market out there. How would you describe the market that we're living in right now?
Well, good morning, Becky. And I think Steve had it right. The environment was tough in the third quarter. That's continued now with rates moving higher. That impacts markets and valuations. I think the key thing for our shareholders is our fee-related earnings are very resilient. They're pretty much flat year on year. Our management fees were up year on year for the 55th straight quarter. And the most important thing is we delivered for our customers. So across our flagship strategies, we delivered performance in excess of what we're seeing in liquid markets. We had real strength in infrastructure, in life sciences, in private credit. And to your point, with more than $200 billion of dry powder, that gives us a lot of flexibility to deploy in what looks to be a dislocated market.
Where do you see those dislocations? Where would you be deploying the dry powder?
Well, I think what's challenging is we're going to see here rates elevated because the Fed's going to stay tight for a while. I think growth will slow to the point Mike was making. You've got, 8% mortgages, 8% car loans. And so what do you think about doing? I'd point to two areas. And one of them would be being a solutions provider. So our private credit business, which has grown to be quite large, we can help companies. We can help consumers in that area. We've got businesses like Tactical Opportunities where we can provide liquidity to companies who need to deleverage. And then the second area would be you cannot rely on multiple expansion or just GDP growth. I think you have to invest in areas where there are some real long-term tailwinds. So if you think about energy transition, an area we've been quite active, digital infrastructure, what's happening in data centers driven by AI is extraordinary. It was the biggest contributor to our value increases in real estate and infrastructure in the quarter. And then I would say globally, India is a place with a lot of growth. We made a large investment in a hospital chain there. We committed in the quarter. So we look at the world and say, yes, it's a challenging place, but there are certainly opportunities.
What is the situation with commercial real estate? That's been a huge issue. That's been something you guys have been concerned about, and lots of others too. But commercial real estate, are we nearing an end to the woes there? Or with rates still so high, is that going to continue to be a problem for quite a while, unless and until the Fed brings down rates?
Well, I'd say there are two notable headwinds. Obviously, office buildings, which you've talked a lot about on your program, face some secular challenges given remote work and some obsolescence issues. For us, fortunately, that's a very small piece of what we do in the U.S. The second challenge, of course, is the rising cost of capital, which does have an implication in the near term for all commercial real estate. I think two things to keep in mind, though. One is if you invest in sectors with higher growth, we have a majority of our capital in logistics, in student housing, in data centers. There you're better positioned to absorb this higher cost of capital. And the second thing is we're seeing a sharp decline in new construction, down 30 to 70% in this last quarter in most areas of commercial real estate. And that lays the framework, the groundwork for a future recovery in value. So yes, the near-term picture more challenging. We like to be long-term investors.
Hey, John, I've always been curious about this. If I go out and buy a home right now, I have to get a mortgage for 8%. You guys buy homes. What is your cost of funds in that space?
Well, the cost of borrowing is not much different, Steve, for commercial investors in real estate and residential investors. You don't have the flexibility to prepay those 30-year mortgages, which Fannie Mae and Freddie Mac allow individual homeowners to have. So there's an advantage. But the cost of capital has moved up, and so that does make the economics in sectors tougher. We do have a structural shortage in housing, and it's one of the areas that's going to get exacerbated by this high cost of capital, which we think will persist for some time.
So does it make sense for you guys to still hold on to that housing inventory, or should you be selling some of that housing inventory?
Well, I think it depends, but I think if you take an intermediate, longer-term view, we've been underbuilding housing by about 4 or 5 million homes since the financial crisis. We're now going to see housing starts, I believe, across multifamily and single family probably come down, exacerbating that shortage. And so if you think about an asset class over time, I think it should have pretty good performance, even if there are some near-term challenges.
John, we've been talking about higher yields from the cost of capital perspective, but, you know, somebody owns the assets, you among them, and so therefore you're earning more off of plain vanilla public fixed income assets, treasuries and corporate bonds. Does that raise the hurdle rate for returns for somebody considering, you know, investing in alternatives? I mean, you've been able to gather all these assets at a time when returns were scarcer.
Well, I would say this. Obviously, when the risk-free rate goes up, you do have to generate higher returns. The good news for us is a couple things. One is we have done that for a long period of time in lower rate environments and in higher rate environments. So if you can buy a business or an asset, improve management, invest capital wisely, drive returns higher, that works in any environment. The other thing I would say is we've got a very large credit business between corporate and real estate credit, nearly $400 billion. Most of that is floating rate, and it's benefiting from this higher rate environment. So you are seeing clients lean in that direction. More than half the capital we raised in the quarter was in the private or the credit space overall.